All-time high of 1.4%. I mean, it's like one would argue and say that, look, that is kissing distance away. You may not make a new high today, you may not make it this week, but you certainly will make it. You certainly will make it very soon. Look, the texture, the fabric, the warp and the web of the market is very simple to understand. This market is currently enjoying a strong tailwind called liquidity from global institutional investors. And globally also, Nasdaq I think is moving from strength to strength. So the mood, I guess, first we must understand in the global market is not risk off, it is risk on. Within that, India is outperforming and we are one of the biggest disproportionate beneficiary of the liquidity reversal. The markets normally peak out when you reach overbought zone, when open interest is alarmingly high, when valuations are completely out of the whack and the earnings season and macros are not favorable. None of the following factors which normally cause volatility or market correction currently are at play. Sentiment is robust, liquidity is strong, macro concerns are receding, and the market still is not enjoying very high interest in terms of participation and open interest. I mean, we may talk about Nifty less than 2% away from an all-time high. Mid-cap index may have touched an all-time high last week, but where's the participation? I think what you have to again focus on that everybody has missed the rally. For those who have not missed the rally, they're feeling the fear of FOMO. Everybody is waiting for a correction and markets are not obliging.
Markets are not obliging, but one of the factors that you pointed out that's working for the markets, it's earnings, right? Now, all the Nifty 50 earnings are out, and if you look at the way the breakup has been, 18 companies reported better than expected numbers. It's only 15 that reported a below expected numbers, but 17 were largely in line. And if you break it down versus the weightage of these companies, the higher weightage companies managed to report a beat versus the expectation. As a result of all of that, we have seen that the FY23 EPS for the Nifty was close to around 838 rupees. And for FY24, now the EPS estimate stands at around 990, which is a still growth of around 18 to 20% on a year-on-year basis. And that means, Nikunj, that the valuations are not very, very expensive. The valuation turns to be around 18 to 19 times. And if I have it right, the long-term average is between 17 to 18 times for the Nifty. So not very expensive, and earnings seem to have caught up.
See, Anisha, the leadership sector is banks, and banks, I often say that they give you a hint of what the economy is doing. Banks are talking about a 12 to 14% credit growth and 16 to 18% credit growth depending on the balance sheet you're talking about. So there is momentum in the economy. What had happened was that last year margins got squeezed because of high inflationary pressure and because of this sudden inflation spike which forced the central bankers to increase interest rates. That had an impact on earnings and that had an impact on market valuations. And the starting point for 2022, after a great comeback in 2020 and 2021, as it is, was expensive. So what happened was market went through price-wise correction, flows were not there, macro headwinds moved against you and foreign institutional investors were selling. Now we have normalized. We had an extraordinary year of low interest rates in 2020 and 2021. We had an extraordinary year of high inflation in 2022. I guess 2023 for me is the normal year where the excesses will get normalized. Luckily for us, we've come on the right side. There are a lot of sectors where things have really moved in the right direction. Defense, manufacturing, automation, banks to some extent, urban consumption. So I think those are the pockets you need to focus in on. My limited point is that looking at the earnings and the current market setup, I guess now the market is not going to go through a massive re-rating. Now you will see incremental gains which would be a function of the earnings growth. So in this market, you can't say, oh, this is overrated, that is overrated. There is nothing which could be called as very cheap. And there's nothing which could be called as very expensive. I'm not hedging myself, but that's the phase of the market. Prashant Jain, a couple of days ago, made a very interesting point. He said, in 35 years I've invested, I've never seen a market where there are excesses on the both sides. Yeah. Well, normally in any market, one is up, other is down. Two are down, three is up. Yeah. So everything is 5-10%, 15% above what the mean averages are, excepting like consumer staples. Everything is in and around the earnings, curve, so to speak. That means from a market standpoint, you're not going to get very large outsized gainers. in terms of a theme now for the rest of the year. You will have to now marry stocks, or you'll have to buy stocks where you will get 15-20% earnings growth.
Yeah, and as you said, just that opportunity to buy into the market, that's not really presenting itself right now. But let's also put the spotlight on what's happening across the globe. You did have on Wall Street as well, the Dow shedding about 50 points, the Nasdaq rising about 1/3%, the stock futures as well looking exceedingly flat. This morning, you've got the Nikkei retreating from its 33-year high. It slipped in early trade. There's losses coming in for the Topix index. It's a mixed basket as well when it comes to the Asian screen. But what is really going to be the focal point is the debt ceiling bill that's being hammered out by the US President Joe Biden and the House Speaker Kevin McCarthy, and that's going to pass a key committee on Tuesday evening. It's going to be fairly critical as well, as we will see that vote take place later this evening. And Nikunj, this is certainly going to be in the spotlight today. God knows how market moving though.
No, markets, from a market standpoint, markets pretty much knew that, look, this is not going to be a big, crack in terms that the debt ceiling talk in the 11th hour, 59th minute would sail through. And that is exactly what has happened. From a market standpoint, it added to a little bit of volatility, but I guess it was evident, let's say, over the weekend that the debt ceiling talks will go through and there would be a deadlock. So purely from a market standpoint, I don't think that is important, and that is not going to be a market moving event. If anything would have not gone through, if a agreement would have not reached, which looks like we will have agreement in place, then that would have added to volatility and numbness in the market. But thankfully, I mean, logic has prevailed over politics. Compulsions and ego battles have taken a backseat. The US politicians are doing exactly what is right now. So I think from a market standpoint, it doesn't change anything. The problem is that the composition of the debt ceiling is such that for next, I think, 14 months or 16 months, they will have endless supply of liquidity. So at a time when US central bankers are trying to reduce the balance sheet size, if there is going to be additional supply of liquidity which comes back into the system, could that really stroke up inflation? I don't have a perfect view on that yet. But if you frankly ask me, from a risk-reward standpoint, additional liquidity coming back into the US economy just when inflation was getting under control, I think is a concern. And if inflation comes back, then whatever we've discussed right now, I think all the assumptions, all the bets would be off.
Yeah, no, you're absolutely right, because even if you look at the CME group, which usually does the poll of what the Fed hike is going to be, it now stands at over 65% for a 25 basis point hike, and a month ago that was just sub 25%. So the expectation that inflation will continue to be high and the rate hikes might continue has also gone up. And also the debt ceiling impact was seen on other markets as well, whether in terms of commodity, wherein we saw a huge decline in the crude prices overnight, which was down about 4%. This morning as well, the Asian markets have started quite a bit on the back foot, whether it's the Nikkei or the Hang Seng Index. They are down anywhere between 1 to 2%. And what's also causing a bit of a nervousness is the fact that the Chinese PMI data has come in much lower than expectation at sub 48 as far as the PMI data is concerned, and that is leading people to believe that the demand for crude and commodities is going to be on the lower side.